is made. Well, the two defined benefit plans, we'll start with the first, and that's the cash balance plan. The characteristics are often described as a hybrid plan because it has a little bit of both, and a little bit of benefit and a little bit of contribution in it. The cash balance plan is a type of defined benefit in which the employer maintains a hypothetical employee account. The employer credits a certain amount to the plan each year and promises the employee a specified earnings, which get credited to that account at an established rate. Now, the interest is also credited to the account at a specified rate that is typically different from what actually occurred. Well, therefore, the actual value of the plan investment at any given time has no impact on your promised future benefit. You'll notice interest rates can be modified moving forward. Participants bear no risk. They know what they're going to get, and it's up to the employer to make sure that they put in enough money, that they invested properly, and that they will have enough to cover your benefits for the rest of your life when you start collecting. Companies of any size can participate in these. Now, contributions are mandatory and are a specified amount. Employee accounts are also credited with a specified rate of interest, as we said. For an example, an employer may credit an employee's account with $2,000 per year and credit the account for an interest rate of 4%. Now, the advantages: participants can watch their account grow. Notice, participants bear no risk. The employer has all the risk of making sure it is the right amount when this person retires. And upon termination, the participant knows exactly what they're going to get in distributions. Now, some cash balance defined benefit plans may only allow a distribution at the normal retirement age. The second type of defined benefit plan is called the pension equity plan. Now, a defined benefit plan where participants are credited with points based on age and based on service. Now, upon termination, notice the average compensation is then multiplied by the amount of points you've accumulated over your employment period. Now, the balance is generally distributed as a lump sum, one amount, or it can be converted into an annuity that you will receive over your lifetime. Companies of any size, any type, can obviously be involved in this. Now, the advantages and operation of a defined benefit plan, well, we have to look at some of the key provisions. You have to understand the eligibility age and the service requirements. You have to maintain that the dates the participant is required to have met. You must meet vesting requirements. You have to determine the annual benefit. You have to determine the benefit distributions, when they can and when they must be paid, and determine accumulated benefits by the actuary and maintain minimum funding standards. Now, the roles in the administration: you have the plan sponsor. Usually the employer provides this and provides notice. The employer is also responsible for the enrollment and eligibility process. Employee data must be maintained, such as birth date, so you know when they'll hit 65, the date they were hired and how many years they'll need to vest, and the date that they finally stopped working. And the sponsor must oversee the distribution process and the determination of eligibility. So we have those two defined benefit plans, the cash balance and the pension equity plan. The cash balance plan guarantees credits per year. The pension equity plan, ultimately it states as a lump sum on a current value that can ultimately be based on an annuity. You'll notice reports and records. Census records summarizing participants' data are provided to the actuary. In fact, we see this regularly with a lot of our clients. We have to fill out certain data from payroll, make sure that HR did it right, and then we submit it to the actuary. We have actuarial valuation reports. They're prepared. And participant account information is kept for cash balance plans and plans allowing the employee contributions, showing the participants' additions and the earnings. Now, missing participants. This can happen, right? Somebody fell through the cracks. So the Employee Benefits Security Administration has created a list of best practices for reducing errors regarding missing plan participants. And these would include maintaining accurate plan census information on an annual basis, creating a communication strategy so that everybody hears you. And of course, now that we have town hall meetings and we have websites to go to, this makes it a little bit easier. We have implementing procedures that regularly search for potential missing participants. Usually the individual who came in after everybody filled out what their planned participation would be. And for some reason, they never were asked to fill this out, and HR forgot about it. Creating written documents regarding procedures and actions. And in addition, we have a third type item we want to talk about. We talked about defined contribution. We've spoken about defined benefit. And now we're going to talk about health and welfare benefit plans. In accounting, we refer to these as other post-employment benefits. And these may provide medical, dental, drug, psychiatric, life insurance, accident, death benefits, even though you ultimately will be retired afterwards. Notice post-employment benefits, severance or disability, sick leave, vacation, tuition assistance, dependency care. These are also part of a current employee's practice. And post-employment benefits or supplemental unemployment benefits could be there. Well, the types of funding arrangements. Well, if you have a defined contribution health and welfare plan, it's maintaining an individual account for each participant, and you have terms to determine the contributions to participant accounts rather than defining the benefits to be received. And by the way, GAAP says that you ultimately determine that amount and you expense it over something known as the attribution period, which would be the period that they first have to start contributing through the period that they're fully vested in that plan, even though they may continue working beyond that. We have, ultimately, they have limited benefits received to the amounts contributed and plus ultimately the earnings minus any administrative expenses. Now, defined benefit, notice, as opposed to defined contribution, these are your defined benefit health and welfare plans. They specify a determinable benefit that may be reimbursed to the participant or directly paid to the doctor. They may include benefits payable in a lump sum, maybe such as in the form of a death benefit. They may define or limit the levels of benefits based on years, ages, or service, and contributions may be determined by an actuarial formula. Now, a plan funded by a fixed level of contribution in the case of a collective bargaining agreement is typically still considered a defined benefit plan. Now, there's always a trust arrangement here. Characteristics are it was set up to hold the assets of the plan. It may or may not be tax exempt, and assets may be segregated or restricted under different trust arrangements for various items. Now, the types of trust, well, you have the Voluntary Employee Benefit or Beneficiary Association, the VEBA. They can be tax exempt, and most common form of trust to hold the investment of assets in health and welfare plans are those. Now, taxable trusts, such as grantor trusts, in which the grantor maintains specific powers or benefits of ownership. Notice those ultimately are taxable. Again, like any other trust, if ultimately the grantor of the trust still maintains power and gets the right to use it, then we tax them. Now, Section 401H, this ultimately refers to a 401H account. It's set up to pay retiree health benefits and is in the form of a defined benefit plan. Related to a defined benefit pension plan, but it's instead of for your salary, even though you're retired, it's for your benefits, even though you're retired. And benefits may be funded by a defined benefit pension plan, and any benefit paid out must be for retiree health benefits and not for pension benefits, right? You had the pension plan for that. This is your health and welfare benefit plan. Well, defining the reporting entity. The forms of reporting entities, well, employers may sponsor multiple welfare benefit plans. Some may sponsor individual health and welfare programs, including a single plan, for example, for medical, dental, and vision. And there could be combination of programs by the employer into a single plan. It's called a wrap plan to simplify the regulatory reporting. Now, generally, if a trust exists, it has to be audited under ERISA. Now, factors affecting the accounting and the reporting associated with this, who's covered under the plan? Obviously, you have to report that. The benefits covered, the determination of who is required to contribute. You have to determine how benefits are funded, and including contributions to the trust, whether it's through general assets of the employer, and parties in the administration. Well, you're going to have an insurance company for fully insured benefits. You may have claims processor for self-funded benefits, and you may have a pharmacy benefit manager. Well, let's take a look at the insurance and the pharmacy. When it comes to the insurance company, the nature of reporting may be affected by whether the insurance company accepts the degree of risk or only provides administrative services. And the pharmacy benefit manager, they're used to provide prescription drug benefits and to help control costs. Now, tax advantages of defined contribution arrangements. Well, you have your flexible spending accounts, your FSAs. It can be set up by the employer through a code section 125. Now, if you've never taken advantage of an FSA, think about it in the future. Here's how it works. Let's say I make $102,000 a year. Well, because of my earnings and my spouse's, we're in the 37% bracket. So I want you to just look at that 2,000. Obviously, the 100 is there, but on the 102, on just that 2, I would wind up paying ultimately 37%, which would be $740. Well, I'm going to tell the employer, I don't want that 2,000. Keep it. Now, I'm not losing it. They're going to put it into an FSA. So I've automatically saved $740 in tax, but I didn't get the 2,000. But the 2,000 will typically go into a medical debit card. And every time I have a medical expense that's not covered by my insurance, I can hand them that debit card. So the deductibles, things that maybe aren't counted, such as maybe my child needed to have braces and they say, sorry, we don't cover braces, or things of the sort. I can use the debit card. And usually now, instead of having just a limited amount of the 2,000, I've got the full 2,000 because I didn't have to pay taxes on it. So it allows the participant to deduct that from their earnings. And because it's deducted from earnings, it's not subject to any payroll taxes. And that includes both income and Social Security. There's also the health savings accounts. Now, they may be established by employees as opposed to the FSA, which is established by the employer. And these are typically with high deductible health plans. Both employees and employers make contributions. Distributions are non-taxable if they're used for qualified medical expenses. And the remaining balance, which you may have ultimately when you retire, may be withdrawn at say age 65 or used to pay for long-term care insurance. We also have HRAs, health reimbursement arrangements. They're similar to your HSAs, except that employees may not contribute to these plans. They're funded solely by the employer. It does not have to be associated with a high deductible plan either. The distributions are non-taxable, presuming that they're used for medical expenses. So when it comes to the Internal Revenue Code 125 plans, those were your cafeteria plans or your flexible benefit plans. They're ultimately sometimes just simply referred to as a 125 plan. The most common types where your medical insurance premiums could be included, out-of-pocket medical expenses could be paid, and dependent care expenses. Now, employee contributions, it's the employee participant election at the beginning of the year, typically October before that next year starts. Now, the amount of payroll deduction or contributions are not taxable to the employee because you've elected not to take the money, but put it into the plan and then use the money that's in the plan that you subtracted from your salary to pay for those expenses. Now, employees are allowed to pay for certain employee benefits on a pre-tax basis before the taxes were taken out, right? You said, don't tax me on this. Don't even give it to me on my W-2. Employees save the payroll taxes and employers also. So you think if most of your employees are making, say, below $140,000, you would have that matching Social Security contribution. Well, by them putting the money away, you as the employer, you also avoid the matching contribution. Yes, there is a use it or lose it feature, but typically the use it or lose it feature is you must spend it by March 15th of the following year. So therefore, if you had the plan in place, let's say you put away $2,000 and you didn't use it all, your little debit card still has some money on it. Well, now it's all of a sudden December 31st. You don't have to rush out and spend it. You have until the following March 15th. To give you an example, my wife and I once took advantage of this. We were blessed by not having major medical expenses one year, and we had a little money left over. So we went to the optometrist and we got prescription sunglasses, excuse me. And by getting prescription sunglasses, something we probably would have never done, it qualifies as a medical expense, and we were able to use our flexible spending account to use up the balance of our money. Well, here's an example. An employee must pay $100 per month for their group health insurance coverage. The company has a cafeteria plan, and one of the allowable benefits is group health insurance. Payroll is paid semi-monthly, and the employee may elect to have $50 per pay period deducted from their paycheck to pay for their individual portion, their portion of the health insurance. The $50 is not taxable for any of the payroll taxes, and the employer also doesn't have to pay payroll taxes on that amount as well. Well, that's going to lead us into Chapter 3. Now, in Chapter 3, we're going to take a look at the following: financial accounting and reporting for ERISA plans. Now, government regulations, the Internal Revenue Code, and the effect on your plan. Internal Revenue Code 401A, qualified trust tax benefits available. Well, there's a current tax deductible to the plan sponsor for contributions. So they get to deduct the amount that they're putting into the plan. It's not like a stock option plan where ultimately they give you stock options and they don't get a tax deduction until you exercise the stock options. And then they get a deduction for the bargain purchase price. This is as soon as they put the money in, that qualifies as a deduction for them. And for the employee, ultimately it's non-taxable. They ultimately got to defer that as income, and it will accumulate tax deferred until they retire. Now, ultimately, there may be an exemption of the trust from income tax earnings as well. Now, favorable tax treatment of the benefit distributions may be in a lower tax bracket. So the logic here is, let's say I'm a high income earner. I'm earning $250,000, and so is my wife. So we're in a pretty high tax bracket. When I retire and I start taking withdrawals, well, I may be ultimately living on maybe $120,000 a year in retirement. And therefore, I'm in a substantially lower tax bracket. So I've taken advantage of the fact that ultimately I deferred it when it would have been taxed at 37%. And now I'm pulling it out as a retiree with a much lower income. And I'm only paying 20% on it, or 15% on it, or 21%, whatever it happens to be. Now, distributions from a qualified plan can be rolled over tax-free into an IRA. Now, this often happens when an individual leaves a job. Usually, they're not happy with the leaving. And they say, you know what, just give me all my 401k. I'm rolling it over into an IRA that's self-directed. I'll make my own decisions from now on. And that is ultimately a distribution that is tax-free. Notice who benefits from a qualified plan? Well, a broad group of employees can. Now, there is a non-qualified plan where it benefits only a few key employees, and it may not be currently funded, and contributions may not provide any current tax deduction to the employer. We're going to take a look at Section 409 and 409A. It allows an employer to make tax-deductible contributions to ultimately the health and welfare benefit plan. Remember, defined contribution, defined benefit, health and welfare benefits. Now, the purpose here, in this particular case of an ERISA on employee benefits, well, it provides the federal government oversight of the operating and reporting practices of the plan. We want to make sure that they're properly investing it in the right things, that they're giving reports, and that ultimately there's no fraud or ultimately embezzlement going on. It establishes reporting requirements for the covered plan, and it establishes minimum standards for participation, for vesting, and for funding. And it establishes the standards for proper conduct of the fiduciaries of the plan. Well, the authority under ERISA. Well, let's look at a bunch of different ones. You have the IRS. They have the authority to issue regs covering the disclosure requirements, administration of it, and when things are deductible. The Department of Labor has the authority to issue regulations covering reporting, disclosures, and administration as well. And we also have the PBGC, the Pension Benefit Guarantee Corporation. They guarantee that participants in most defined benefit plans receive certain minimum benefits if the plan terminates. You'll notice we also have administers termination benefits in certain circumstances. Well, plans under ERISA. Obviously, the employee benefit plans established, set up, or maintained by employers engaged in interstate commerce or those that affect interstate commerce. And you'll notice it representing employees engaged in those types of activities. Well, there are three primary purposes of ERISA, and those are to ensure that plans, 1, vest accrued benefits for employees with substantial service, 2, meet minimum standards for funding, and 3, subscribe to plan termination insurance for defined benefit plans with the PBGC. Notice plans to which the aspects of ERISA do not apply, which means you're not required to file a 5500. We'll talk about that in just a couple of minutes. Notice this would be government plans, including those of state and local governments, church plans, with some exceptions, and plans set up to comply with worker comp, unemployment comp, or other disability insurance laws. And finally, plans maintained outside the U.S. primarily for non-resident aliens. Now, minimum guarantees under ERISA. An employee cannot be excluded from participation because of age or because of service. An employee cannot be excluded if he or she has attained at least the age of 21 and had at least 1 year of service. One exception, a pension plan may defer service until 2 years of service and age 21 if benefits immediately vest 100%. Now, vesting and non-forfeitable rights. Contributions by participants are non-forfeitable. In other words, or 100% vested. The money that you deferred and put in is always yours. You have the right to that no matter what. Vesting of the employer contribution or benefits have minimum vesting requirements based on the years of service. So an example might be that ultimately for every year you work, you'll get 3% or 4% up to a maximum of 33 years or 25 years, whatever the case may be. Now, a year of service is defined as 12 months and has been completed with at least 1,000 hours of service. Participants become fully vested upon termination or partially termination of the plan, and plan administrators must maintain sufficient records and furnish the participants with statements on a regular basis, which usually means now, of course, in today's environment, every quarter you can look up what you're doing, right? You can go online and go into your plan. Minimum funding standards. Pension plans must maintain a funding standard, which is known as an FSA, which is a memorandum account not included on the plan's financials. Now, certain defined contribution plans must keep FSAs on a limited basis to determine compliance with minimum standards. For defined benefit plans, the sponsor's annual contribution must be adequate to cover normal period costs, amortization of the unfunded bump up in benefits, I'll talk about that in a moment, and changes related to plan amendments, gains and losses, and changes in actuarial assumptions. So essentially, there's a whole bunch of items that go in to that plan. There's the current pension service cost, which is ultimately, in this case, the service cost is you're 1 year closer to retirement, you have 1 more year of service vesting, so there's an actuarial calculation. Then, of course, it's the interest, the investment, how much it should have earned in a perfect world. Then there's minus the actual return. You kind of net those two. Then you're amortizing any bump up in benefits based on amendments. Then the holding gains and losses, not the ones you sold, but the holding gains and losses. How much have the stocks gone up or down? How much is the real estate you own gone up or down? And then any other actuarial changes. Now, the trust requirements. The Internal Revenue Code requires pension and profit sharing plans to be funded through a trust. So it's not like, oh yeah, we got this earmarked inside the company. It's in our bank account, but we know it's for you. No, it's got to be separated into a trust. And notice ERISA requires all employee benefit plans, including pensions and welfare, be held in a trust. Now, there are some exceptions, certain insurance contracts, and those of public schools, the 403B ones. Now, employee contributions to a pension or welfare plan must be deposited into a trust in a prescribed amount of time. So the money you took out of their paycheck, you can't play with that for like a year and a half. You got to put that in a very short period of time. Now, let's talk about plan requirements under ERISA. And these are the reporting requirements. First is documentation. The administrator must furnish to the Department of Labor, upon request, any documents, including 1, a summary of the plan description, 2, bargaining agreements, and 3, the trust agreement. You must, most plans, must file an annual report, as we said with ERISA. There are a couple exceptions, as we said. And of course, you got to file a tax return. Even if you're tax exempt, you still got to file the 5500. Administrators must furnish specific benefit plan information to participants and or beneficiaries. Now, I mentioned this term, the 5500. It's the annual return report for an employee benefit plan. And here you'll notice that the IRS, the Department of Labor, and the PBGC, they have joint agency designed for this form. So remember, the PBGC is the Pension Benefit Guarantee Corporation. Now, it's an annual report and is the most significant to the auditor. Well, who is required to file it? All pension benefit plans and welfare benefit plans covered by ERISA and not otherwise exempt. The reporting requirements, Well, the 5,500 varies slightly by large plans, small plans, and direct filing entities. We're going to talk a little bit more about them in a few minutes. Now, filing is required even if there is no contributions to the plan for the current year. So who's exempt? Well, we have 8 types of exemptions. 1, an unfunded excess pension plan. 2, a welfare benefit plan that covers fewer than 100 participants as of the beginning of the year and is unfunded, fully insured, or a combination of insured and unfunded. The third one is a church pension benefit plan not electing coverage under Section 410 of the Internal Revenue Code. Number 4 is a pension benefit plan covering only an individual and their spouse who own the business. So we're not worried. Again, they're the ones handling their own plan, and it's only for them and not for any other third parties, such as employees. So we're not worried about having them have to take an audit. Obviously, government plans are excluded. A pension plan or welfare plan maintained outside the U.S., primarily for people who are non-resident aliens. A pension plan for partnerships that cover only partners or partners and their spouses, once again, the owners. And finally, an employee benefit plan maintained only to comply with workers' comp, unemployment comp, or disability insurance laws. Well, the types of filers. We have a single employer plan. We have a plan for a controlled group, which is, again, a company under common control with all their divisions. We have multiple employer plans, a plan in which more than one employer is required to contribute. For example, a union plan. So theoretically, think of all of the big auto manufacturers, General Motors, Ford, and Chrysler. Well, there may be unions, the same union for all of those companies. And the union has said, we want our people to have X amount of pension plans. So the companies in collective bargaining have agreed to that, and they put it all into this one plan that literally will be overly administrated by the union. Obviously, maintaining subject to one or more collective bargaining agreements. And another one for multiple ultimate plans would be participating employers who do not file individually for these plans. Now, participants, well, defined by ERISA, it's as any employee who is or may be eligible to receive benefits, even if the employee has not had account balance at this point in time. In the case of a 401k plan, which is most of us right here, a participant is an individual who is eligible to participate in the plan, even if they've elected not to contribute. And for purposes of the 5,500, the determination of number of participants in the plan is calculated as of the beginning of the plan year. We're going to see a rule coming up in just a little bit called the 8120 rule to determine if you're a small or a large company and need to have the smaller or the complete audit. Now, notice right here, plans required to file would include, now under the defined contribution, remember there were 8 defined contribution plans. 5 of them are required to file. That's your pension sharing plan, or profit sharing, excuse me, your money purchase plan, your ESOP, your 401k, and your 403b. Those are the ones that are going to require ultimately that you have to file a 5,500. Now remember, there were 3 others in the defined contribution plan: the 457, the SEP, and the KESOP, the KSOP. Now with defined benefit plans, remember defined benefit as opposed to defined contribution, both of those plans, the pension equity plan and the cash balance plan, both of those are required to file a 5,500. And your welfare benefit plans, those are also required to file the 5,500. So the 5,500, some additional disclosure schedules, and these are for plans with 100 or more participants. Now, remember, determination is made as of the beginning of the year. We're going to learn about a little wiggle room you get if you're between 80 and 100, right? We're going to learn a little bit about that. So let's assume that you're 100 or more participants. You ultimately are going to be required to file a Schedule C, reporting payments of $5,000 or more paid by the plan to any service provider. And you're also going to ultimately report changes in your service providers. Schedule G is reporting supplemental investment information. Schedule H, and you're going to see a lot about this as we go a little bit further on. It reports financial information and details of the assets and liabilities. Essentially, you're going to have your balance sheets and your income statements on that schedule. Schedule R is your retirement plan information like funding, amendments, distributions, and it can also be used for plans with fewer than 100 participants. Schedule SB is for single employer defined benefit plans, where you're going to disclose actuarial information, calculations, assumptions, and it applies to plans with fewer than 100 participants as well. So be aware that later on when we talk about small plans, we're still going to have the Schedule SB if it's a defined benefit plan. We're going to have Schedule MB, which is multiple employer defined benefit plans. We're going to have actuarial information there. Schedule A is insurance information. It's attached if any benefits under the plan are provided by an insurance company. And then we also have the annual report. Now, we have small plans, which are fewer than 100 participants, but we have this 80-120 rule, which I mentioned before, which says that if at the beginning of this year, your number of participants is between 80 and 120, and you filed a 5,500 last year, including Schedule I, then you have the option this year of either filing as a large or a small plan. You can have your choice. Notice, now, what is a small plan? You have to file Schedule I, which is financial information, details of your assets and your income. Schedule R, which is retirement plan information. Schedule A, which is insurance information. And Schedule SB, which is ultimately defined benefit information. All the same as the large. Now, the short form 5,500, ultimately limited to the small plans with fewer than 100. Investments are limited to readily determinable market value instruments. Assets do not include any employer securities. You'll notice here, one of the big things is we don't want somebody who's a smaller company to say, oh, well, we're going to take all of the investments and buy stock in the company of the owner. Obviously, there's kind of a double dipping going there. You get the deduction, and then you have ultimately all these shareholders who in a group own some of the shares, and you've pulled in all the money again. So you paid the money out, got a deduction, and then you got it back by issuing some of your own stock, and they say, maybe that's not the right idea. And schedule requirements are more limited than with the large companies, which have to file the full and complete 5,500. You'll notice Schedule SB, the single employer defined benefit plan, is required if you are a single employer with a defined benefit. Schedule MB is if multiple employer defined benefit plan, in this case, is required for money purchase plans, amortizing a fund waiver using the form SF. Now, for other small plans, there are some other filing differences. You must meet the audit waiver conditions to file the 5,500 SF. Now, you have to have at least 95% of the assets must be in qualified plan assets. In other words, assets that are held by a qualified institution. So it's, Deutsche Bank. It's going to be one of those big financial institutions where it's readily determinable that the money is there and what the amount is. Assets typically are held by a bank, a brokerage, or an insurance company. Now, if requirement is not met, then additional fiduciary bond coverage is required. Now, additional bond coverage must be disclosed in your summary report. So how about a summary annual report to the participants? What information do they deserve? Well, they should have information about the total assets at the beginning of the year, the number of participants, and total plan income, and of course, the administrative expenses that were associated with it. We also want to include the amount of distributions that were paid out, information about the plan administrator, their name, where they're located, and the name of the investment company holding the assets. Now, timing of filing of the Form 5500, it must be filed by 7 months after the close of the plan year. So theoretically, if a plan had a December 31st, that would be July. Now, you do have the ability to file for an extension, 2.5 months. So that would put it ultimately past August, September to October. And that would be a Form 5558. And it should be filed before the original due date, asking for the extension. Now, the extension may also be granted if the plan sponsor has an extension on a corporate income tax return to the due date of the corporate return. Now, most C corporations, their tax returns are now due on April 15th, and they have a 10-month extension to October 15th. Now, Section 125 cafeteria plans. Remember, we talked about the FSAs, the health savings accounts, and the health reimbursement accounts. We spoke about them a little bit earlier. Cafeteria plans are not required to file any additional Form 5500 schedules. Now, not a brand new, but a notice that we should be aware of is Notice 2002-24. It eliminated the need to file Schedule F for cafeteria plans, but they may still be required to file a 5500 to report the plan's welfare benefits covered under Title I of ERISA. Cafeteria plans must still follow the reporting rules for welfare benefit plans, and Section 125 plans are not required to have separate trust arrangements. Let's chat about a little bit about plans pursuant to the SEC. Now, plans subject to the requirements of the Securities Act of 33 will start with defined contribution plans. A defined contribution plan allows the participant employees to invest their funds in the employer securities. So additional requirements, in this case, filing requirements are requiring, one, the title and address of the plan, the name of the issuer of the securities, the audited financial condition for the last 2 years, that's your balance sheet, an audited statement of income and changes in equity, the income statement for the last 3 years. You must submit an audit in accordance with PCAOB standards to the SEC, right? The Public Company Accounting Oversight Board, they establish the standards for auditors who are auditing publicly traded companies, including these filings. And you must submit the audit in accordance with generally accepted auditing standards, GAS, established by the Auditing Standards Board, known as SASs, for filing with the Department of Labor. Now, Form 11K must be filed within 90 days following the plan's fiscal year end. For plans subject to ERISA, they must be filed within 180 days of the plan's fiscal year end. Well, that's going to lead us on to internal controls using a service organization. So now in chapter 4, we want to take a look at the following. 1, service provided by a service organization relevant to the operations and audit of the employee benefit plan. Whew, that's a long title for us to have. Now, service providers. Well, this would include trustees, the responsibility for record keeping, the custodian, the party who actually holds the assets, usually say a bank or an insurance company. Often the trustee and the custodian are the same party. Sometimes the custodian is an institution and the trustees are individuals, such as ultimately maybe some former executives, former partners of auditing firms, etc. Notice the custodian may perform investment functions such as collecting income, purchasing and selling of securities, right? The custodian, typically being an institution, you may have it ultimately at Goldman Sachs, you may have it at Morgan Stanley, you may have it at Bank of America, you may have it at one of the other companies, Deutsche Bank, right? And they'll make the decisions. They may ultimately run it by for determination as to what the plan should be doing now. Now, the investment manager, they're the one that makes the investment decisions and directs the custodian to purchase and sell. The investment manager may be an internal person to that institution. That's why it's really the institution that's making the judgment. But it may be a third party. Record keeper. The record keeper keeps track of the investment transactions, right? This is your party that says, here's what's being done, here's what ultimately was recorded, here's the gain or loss, etc. Now, the record keeper is responsible for accounting for the participant accounts, which means every single participant, valuation of the investments, and of course, valuations can be based on level 1, identical items, level 2, similar items, or level 3, unobservable inputs if it's a unique area. Obviously, processing of checks and the preparation of participants. Now, the record keeping is not responsible in this case for plan investments. So the record keeper and the custodian and the investment manager are typically different people. Notice what we would call that there as segregation of duties. Now, often the record keeper is a third-party administrator, right? The record keeper is that third party. There may be a pension plan administrator who says, we're going to ultimately do some of that. We'll handle the record keeping and the reporting. We're not in charge of investing, but we are in charge of these items. Now, third-party administrators, they may assist with some or all of the following: accounting for the participants' accounts, participation of participant statements, or preparation of them, processing of distributions that are appropriate. Now, other plan administration functions could include the following: performing compliance tests, plan design, calculation of employer contributions, allocation of employer contributions, preparation of the annual 5500, keeping the plan documents up to date. And that's a very important item. You know, one of the things I've seen a couple of CPAs get burnt on is CPAs say, listen, I'm going to handle it. I'm going to be your administrator. I'm going to do all of this. And they don't realize that these plans have new requirements every other year. The government comes out and says, you got to do this, you have to do this, you have to report this. And they don't keep up on that. And all of a sudden, the plan is now out of compliance, and it ultimately becomes disqualified. And now your client is very unhappy. Usually it's recommended to make sure you get somebody whose full-time job is keeping up with ultimately the rules, the regulations, the changes that need to be made. And of course, another function that the administrator might have is determining employee eligibility. Well, the actuary in the defined plan, right? Well, think about this. If you have a defined benefit plan, you're going to need an actuary, right? You've got all these people spread out throughout the company. Some of them are young, some of them are middle-aged, some of them are getting old. You may have already had some people who've retired. And of course, they all have different income levels. And now you've got to figure out, like, how much do we have to put away this year for everybody being one closer to vesting, 1 year older and closer to retirement? And then how do we calculate all the rest? This is where we need the actuaries to come in, right? They're going to look to determine, based on everybody who's there, what's the likelihood, actuarially, how many of them will ultimately fulfill the working requirement, invest. Of those who vest, how many of them will live to be long enough to start collecting? Say it's age 65. of those who vest and reach age 65, how long will they live actuarially? So we're going to have enough money to cover either an annuity, or we're going to have enough money to ultimately withdraw X amount every single month to cover them, right? It's all actuarially calculated. That's why we need them. We have to determine the minimum funding requirement. How much do we need to put away this year? How much can we put away? We have to determine any contributions due for the year, right? There's minimum standards you have to meet, and then you have to try to make up the rest later on. By the way, many companies, when the Tax Cut and Jobs Act came out back in 2017, President Trump had been the signer of it. He reduced the corporate rate from 35 to 21. And that was like near the end of December, like the 20th of December. Many companies that were calendar year ends rushed to make contributions in that year. Why? Because if they made a contribution that year, there was a 35% savings on tax. If they made it 2 weeks later in January of the next year, well, then there was only a 21-cent savings. Ultimately, in that case, much better to get a 35% savings than a 21. So you had a lot of companies that put in billions and billions of dollars in a very short period once this was signed into law. Ultimately, we have to determine, as I said, the contributions due and calculate any benefit payments due to participants who have vested, retired, and are now entitled to those amounts. Now, payroll processing companies. You may be using an outside service company, such as, say, an EBP, used by many employers to process their payroll. Well, the nature of services and the interaction between the service organization and the plan sponsor. Services provided relevant to an audit. Well, they maintain the accounting records. Think of a payroll company like an EBP, right? They're keeping payroll records every week. They're doing the quarterly filings for you of the 941s. They do the annual 940s. They issue the W-2s, etc. Ultimately, they literally have management. There may be management of investments. That would be obviously your Deutsche Banks, etc. Processing of investment transactions, safeguarding of assets held by a custodian, maintaining an individual participant account, processing of benefit payments, processing of payroll transactions, and processing and maintenance of the participants' loans. If they were eligible to take out a loan of X amount of money, but they had to pay it back, obviously they have to pay it back with interest. They pay the principal and the interest. Somebody's got to keep track of that. Well, obtaining information about the nature of the services provided by a service organization. Some of those other items that you're going to want to obtain is a review of the trust arrangements and agreements. You're going to want to read the service contracts to make sure what they're responsible for and what they're doing, and determining which service applies to each service organization. So ultimately, you may have one that's doing administration, one that's handling payroll, one that's handling investment accounts. So you want to make sure you have a complete understanding of who's doing what. The last thing in the world you want to find, and typically this is what happened in the first year or so, you find out that something fell through the cracks and something is not being kept up to date. By the way, with payroll organizations, I will mention also, critical in these last several years was getting documentation to support an application for a forgiveness of debt with a payroll protection program. Well, monitoring service organization controls. In monitoring the service organization controls, we're going to be looking at the following items. One, a critical step is understanding the quality and the effectiveness of the service organization's processes, procedures, and controls. Now, in evaluating them, the auditor should determine whether, number one, participant enrollments, cash receipts, and the disbursements of plan assets are processed completely, accurately, and in a timely manner. Dividends are timely and accurately recorded on investments. Investment transactions are applied properly, right, to the individual in the account. And plan assets are safeguarded from loss or misappropriation, fraud. Participant transaction confirmations, account statements, and reports are accurate and timely. Year-end compliance tests are completed. Changes to systems and software are tested and approved. Access to the facilities and the programs is limited to authorized individuals, and new plans and mergers are established in accordance with plan documents. But we're going to have something called a service organization control, a SOC 1 report. We're going to learn about a SOC 1, and we'll also learn about a SOC 2, a type 2 plan. Well, let's start out. What is a SOC 1? A service organization. It helps the plan sponsors to understand and monitor the quality and effectiveness of the service organization's process. Think of ADP. You hand them all the records for all the employees who work this week, and they process it, and then they obviously wire transfer the money that you have transferred into their account to the employees. Well, in this case, how do you know they didn't take a couple extra of their people and add them in? Did they get everybody right? Did they have the right amount of withholding? Think of also your administrator in handling transactions and buying and selling the stocks. Were they properly recorded? Was there any fraud involved? So you want to know, do they have strong controls so that no bad things can happen? Well, there's performance of report. The CPAs perform examinations of controls at the service organization. So if you think of one of those, could you imagine if every company that used that service organization said, our auditors have to come and audit your controls? There would be thousands and thousands of audits going on. Well, the service organization says, hold on, rather than sending your auditors in, we're going to have an independent set of auditors test our controls and issue a report that says our controls are effective so that your auditors can rely on the data that we're giving them. So these would be called a type 2 SOC report or ultimately a type 1 SOC report. Now, a type 2 SOC report is the same as a type 1, but it also includes the description and the results of the CPA's test of controls. Well, why is there a greater demand for SOX reports? Well, there's a concern over quality of accounting information. Obviously, more outsourcing of planned administrative services and we're getting is appropriate. So if ultimately the service organization had an inspection of their controls and procedures and an independent third party said, yep, thumbs up, these are good, well, then we're much more comfortable about it. Now, a SOC report is not mandatory for a service organization, but it certainly does reduce the amount of, obviously, interference in their operations that could happen. Now, notice, not having a SOC report could have negative effects. It may be difficult to determine if the controls at that service organization are operating properly. And you may have more procedures being necessary to verify that what they're doing and giving you is still accurate. Now, it depends on, in this case, the significance of controls. It depends on the degree of interaction between the service organization and the sponsor/employer. Notice, interaction is to the extent that the user entity is able to implement effective controls over the processing. Now, if a service organization is allowed by the plan to execute transactions without specific authorization of each transaction, there is less interaction and less control over the organization, which means what? Which means greater risk means you need greater assurance. So here we're looking at the risk of material misstatement. And when it comes to the risk of material misstatement, we want to focus in on the following. It depends on the nature of the service being provided. If the plan has proper controls and they are operating effectively, the use of the service organization may decrease the risk of material misstatement. Now, assume that the plan sponsor does not have the expertise or the resources to perform that particular activity. Well, if the plan sponsor does not maintain independent accounting records, the auditor must, notice the word must, evaluate the services provided and the impact on the user entity's internal controls to better assess risk of material misstatement. And we have some examples of scenarios where a plan sponsor may not maintain independent accounting records. Your 401k plan with enrollment done on an automated phone line or on a website. A welfare plan with claims processed electronically. Well, additional design and implementation of controls on a service organization. Now, if the auditor is unable to obtain an understanding from the user entity, the auditor should gain that understanding by using the following. Obtain a SOC report That's your service organization controls. Contact the service organization through the user's entity to obtain specific information. Visit the service organization and perform procedures that will provide necessary information about their controls. And use another auditor to perform procedures and tests that will provide the necessary information. Well, notice here, controls of participant information in a service organization. One, it provides reasonable assurance that the participant's data is recorded properly and accurately, such as the amount that's in the pension, the amount that's in the welfare plan, ultimately the transactions that have occurred, that participants have received their money, that the money that we withheld from their paycheck is now properly reported in there, etc. Obviously, confirmation notices to participants to confirm the record-keeping system is accurate, procedures for a regular review of the participant statements, and follow-up procedures for confirmations. You want to determine if employees meet eligibility requirements before they're enrolling. And of course, when it comes to disbursements, you want to develop proper procedures for loans. Are they allowed? And if so, up to what amount? And by whom? And how do we record them? And how do we verify they're paying them back? Withdrawals, disbursements, and forfeitures. Confirming quarterly participant statements is appropriate, and performing follow-up procedures might be necessary. Well, that's going to lead to our final category, which is audit requirements. Now, when it comes to audit requirements, what we want to do right here is we want to examine the following. ERISA requirements, pension plans. As we mentioned earlier, you have the requirement of filing the Form 5500 as a large plan requiring an audit of their financials by an independent, qualified public account. Notice it doesn't say certified public account, but general rule, it's going to be a CPA. Now, these plans include what? Plans with 100 or more participants at the beginning of the year, and plans that must file Schedule H. I told you we were going to regularly see that. And that's for your large plans, and it's the reports the financial information and details. Obviously, the 2 years of balance sheets, the assets and liabilities, and of course, income statements. Now, when you have the plan that has more than 100 participants, ultimately, we're going to look at active participants, current employees covered by the plan, and earning or retaining credit service. It includes individuals who are eligible to contribute to their 401k. Now, you also have retired or separated. Those are participants who are still receiving benefits. You have retired or separated participants entitled to future benefits. Maybe they left, but they're only 61 and they have to wait until they're 65 before they can start receiving. And deceased individuals. Those are individuals who have one or more beneficiaries who are receiving the amount that they are otherwise entitled to. Next, welfare plans. Well, they have the same audit requirements as pension, defined benefit, defined contribution, with the following exceptions. If the criteria below are met, the plan may be exempt from the audit requirement. Notice, number one, they pay benefits solely from the general assets of the employer. Number two, they provide benefits exclusively through an insurance contract or policies issued by qualified insurance companies or through a qualified health maintenance organization, an HMO. And finally, premiums paid directly out of the general assets of the employer. Well, here's that 80-120 rule again. We mentioned it a little bit earlier. So are you ultimately going to have a limited or a full-blown type situation for your 5500? The rule states that if you were between 80 and 120 participants at the beginning of the plan year, and if you recall, it's always the beginning of the plan year that we make the assessment as to, how many people you had. And you had filed a 5500 for the prior year. And the plan may elect to use the filing status of large or of small, as in the previous year. Notice requirements to qualify. The Form 5500 was filed in the prior plan year. Schedule 1, or I in this case, was filed in the prior year. And the number of participants entered on the 5500 as of the beginning of the plan year is between 80 and 120. Ultimately, why would you want the smaller one? You've already done the large one. Well, if these requirements are met and the Schedule I was filed for a small plan the previous year, the plan may still file a small plan for the current year. And here's the important one: no audit is required. Well, the Form 5500, plans with 100 or more participants as of the beginning of the plan year, not qualifying for the exception of filing as a small, ultimately must file the 5500 as a large filer. And we went through all of the schedules that they have to file with it. You'll notice annual audit requirement is part of it. Remember, the 5500 small, not required. 5500 large, absolutely required. Plans are required to engage an independent, qualified public accountant, which generally you're going to think of as a CPA, according to ERISA. The accountant's opinion accompanying the financials and the notes must be attached to the Form 5500. Now, audit acceptance. Obviously, establishing policies and procedures should guide a CPA firm's decision to accept, obviously, one of these ERISA pension plan audit engagements. The firm's policy should include consideration of the following. Think of your own quality control procedures. Your own quality control procedures would be, first of all, are you independent? Number two, do you have qualifications to be able to do this? Do you have the manpower to do it? Etc. All of those quality control procedures should be in place. Ultimately, you want to consider the reputation and integrity of the company requesting this, right? If the company doesn't have the kind of integrity that you want to be associated with, it's better not to be associated with them right from the start. Whether the CPA firm has the necessary competent individuals and comfort that the legal and ethical requirements can be met in completing the audit, right? That would include your independence. Now, the auditor, what should the auditor do in this particular case? Well, the auditor should receive an acknowledgement from management of the firm requesting the EBP audit regarding, right? Obviously, this would be your proverbial engagement letter. And in the engagement letter, they would acknowledge the responsibility, management's responsibility to maintain current plan documents, and current plan documents including all plan amendments. They would also acknowledge administration of the plan complies with ERISA to the best of their knowledge, and management affirms that appropriate records have been maintained to correctly determine the benefits of all participants. And you can see, should management elect to have an ERISA ultimate audit, this is your limited audit under a 103A3C, which we're going to talk about in just a minute. The audit performed, management affirms circumstances that they met the conditions. A qualified institution has prepared and certified where their investments are, and all information related to the plan investments used is applicable to the framework. We're going to talk a little bit more about them in just a minute. Now, one last item in this area is cybersecurity risks. Cybersecurity, for the first time, the U.S. Department of Labor has issued guidance on cybersecurity regarding protecting retirement benefits, and it includes information on selection of service providers, best practices related to information security to assist record keepers, and basic rules for plan participants and beneficiaries related to reducing the risk of fraud or loss due to cybersecurity failures. Well, an ERISA Section 103A3C, these used to be referred to as limited, all right? And then we're going to see limited, and then we'll see general, large, full-blown scale. So what is the audit report? Well, ultimately, the scope and nature of the ERISA section, audit section, is required to be presented first. The opinion section is required to follow the scope and nature, so you're going to have your opinion there. The basis for the opinion is required to follow that. There's the enhanced auditor reporting related to going concern. There's the expanded description of management's responsibilities. There's the expanded description of what are the auditor's responsibilities, and the required other matters paragraph. Well, in this audit, you're going to have your investment and investment income. The investment information is not subject to audit procedures if, and here's the critical item, if the plan management elects the ERISA Section 103A3, A3C, sorry. Well, the requirements for meeting that and ultimately not being subject to certain audit procedures. The investment information is prepared and certified by a third party. Who's the third party? A bank or other regulated financial institutions like a credit union, an insurance company that is regulated by the federal or state, a trust company, or other regulated institution. So a third party that ultimately the U.S. government says we're comfortable with them giving you accurate information. So ultimately, if they give you the information and they certify that they are holding X amount of money of yours and that's all the money that you have put away into the pension, then obviously the investment information will not be subject to additional audit procedures. Well, this ERISA section exemption does not apply to investments held by brokers or dealers or an investment company. You'll notice a trust company that is regulated by the state would be eligible. But otherwise, if you're dealing with a broker, how do we know? And again, qualified certified institutions must certify both the accuracy and the completeness of the investment information that's being submitted. Notice plan management is responsible for determining that the conditions of ERISA exemptions have been met if you're going to take advantage of that. Now, the opinion on an ERISA audit must address each of the following. Number one, it must address, in this particular case, the amount and the disclosures in the ERISA plans statements that are not covered by the certification that are presented fairly in accordance with the applicable framework. So maybe 80% is with a specific institution that's certified, and they've certified those amounts. The other 20% maybe is with a broker, and that amount needs to ultimately have audit procedures associated with it. So you're going to break out those amounts. And the investment information in the ERISA plans, financial statements related to the certified investment information agrees to or is derived from the certified investment information that was provided by that qualified institution. So we broke it out between that which is with a broker or a dealer and that which is with ultimately the financial institution. Now, SEC reporting, the ultimate ERISA audits are not acceptable for SEC purposes for employee pension plans required to file the 11K. Remember, you have the Department of Labor, you have the SEC, and ultimately with the SEC, ultimately they are going to probably require this full scope audit as opposed to a limited scope, which we just talked about. Now, a full scope audit includes all areas of audit that are covered, including investment information. So even if you have it with the bank, this is performed when the plan does not qualify for a limited scope audit, which we just talked about. And in this case, ultimately, it's based on the following criteria. The invested assets are not held with a certified institution. The plan did not elect a limited scope audit, and the institution did not provide the required certification of the plan items. Well, consideration. You'd want to factor in supplemental schedules are required. And boy, did we see a lot of them. We went through all the schedules. Oh, and here it is again, Schedule H, detailed financial information. Now, supplemental schedules are reported as part of the financials, and they're reported in the other matters paragraph. And a separate report on the supplemental schedules is typically going to be done. Now, elements of the reporting supplemental schedule, a statement that the audit was conducted for the purpose of forming an opinion on the financials as a whole, a statement that the supplementary information is presented for the purpose of additional analysis and is not a required part of the financial statements. Also, a statement that the information is the responsibility of management related to the underlying accounting information, just like a regular audit. Management's responsible for that. And a statement that the supplementary information has been subjected to the audit procedures. Now, audit risk and response. The plan document is critical information to help the auditor to identify potential risks and evaluate the controls. Now, the auditor must review the plan documents and all amendments to understand exactly who's eligible, how much the company puts in, how much employees put in, ultimately where it's supposed to be stored, when disbursements can be made, when loans can be made. Now, the evaluation of risk should include the potential for material misstatement, right? You want to look at, and these are the same three categories that we have in any audit of any financial. You're going to be looking at risk in classes of transactions, account balances, and of course, disclosures. Well, the auditor needs to determine if management has completed necessary IRC compliance, Internal Revenue Code compliance tests, and corrected or intends to correct any failures that have been discovered. Now, if prohibited transactions have been identified, the auditor needs to determine if they have been reported on the supplemental schedule as required by ERISA. Management's handling of prohibited transactions may impact your audit opinion. But what are some of these reportable findings? When the auditor finds transactions that do not comply with the plan's documents, first thing they should do is they should evaluate to determine if the standards of reportable findings have been met. So what are reportable findings? Well, they include instances where there is non-compliance with laws and regulations. That's a reportable finding. Actions of those charged with governance, the leadership, that are significant or relevant to plan management's responsibilities. And reportable findings would include internal control deficiencies, not known by management, that the auditor identified as significant importance. So obviously there's a weakness that has been discovered. Those are reportable findings. Well, Revenue Procedure 21-30. This states that the changes included in this update provide some additional flexibility in the plan administrator's ability to make necessary corrections on a voluntary basis. So what are the updates? Well, they include the following: the elimination of the Voluntary Correction Program, the VCP, anonymous submission procedures as of January 1, 2022. That was the elimination of that. And then there's the extension of the self-correction program, correcting period for significant failures by 1 year. The correction period is changed to the end of the third plan year following the plan year in which the failure did occur. Now notice, a correction increases a benefit, a right, or a feature by retroactive amendment under this plan, under the self-correcting program. And it may be applied only to certain plan participants.